guys, so much to digest, but it's interesting that the social media names generally do seem to be moving lower. So is the theme that this isn't just a Twitter story, that perhaps this is a story about lackluster growth in some of the strongest, fast-growing parts of the market?
I think that's exactly it, Kelly. I don't think anybody's been able to combine user growth and revenue growth in the explosive way that we saw Facebook achieve it. Twitter, nice on revenue, but the user growth, nah. And then we see Pandora come out a little bit weaker than we were looking for in the guidance. Yelp about in line, but certainly not blowing the doors off there. I think we were expecting more from the social media cohort, especially much in the past few months.
And Josh Velser, Brian Hamilton are still with us. And Brian, to you, your thoughts here as you look through Twitter specifically and
Sure.
see, is this a story about execution there, or more broadly just about the extent to which all of these names can compete for some of the same population?
Right, Kelly. There's only one story here to me. It's still valuation. These guys are 56 times trailing revenue. It's a huge valuation. Look at Google, 15 times. Microsoft, 5 times. Look at Facebook, 23 times. These guys are way out of bounds on value. Now, I will say this, to Josh's point, I like positive cash flow from operations. That's a good thing. The GAAP versus non-GAAP earnings, I'm a little confused by that. But the story is not just revenue, it's value.
Yeah, I think you can have an enormous valuation if the sky is absolutely the limit. The minute you start having growth of only 9 million new users in an active quarter, that's just not enough. Actually, if we look at Yelp, which is the only one that's doing okay right now, the number that I really teased out there that's interesting is 67,000 active business advertisers. I think most Street analysts were looking for 62,000. So that's a case there where the picture is so much bigger than people thought that it might be, allows it to sustain that oversized valuation. But the minute you show any signs of slowing or not enough growth, things come down to the ground.
We learned.
Yeah, right on. Look, right on, exactly. How many companies in the history of American commerce have doubled profits for 10 years? Nobody. So this company is a young company, and once you get a dip down, they're going to be punished in the market, which maybe they should be. Although I do like that their net margins are getting a little bit better, so that's good news.
David?
We learned intimately 14 years ago that valuation matters, probably more than any other fundamental metric when it comes to stock.
You're talking about the .com?
Absolutely. And Yelp, 23 times sales. That's priced for perfection. But Google, at 6 times sales, I think represents value. I'm overweight tech. When I look at the free cash flow yield in technology, where the average tech stock's trading at about 5% free cash flow yield, that's above the overall market. I want to be overweight at tech in names like Google or Qualcomm, perhaps even a name like Facebook.
Should people be worried, though, that these are the disruptors, or does today, I guess, kind of go back to that point, which is it's fine to bet on some of the disruptors, or I should say disrupted. It's fine to bet on some of the disruptors as long as that's what they're doing, right?
Well, certainly, and I don't think you're going to write off any of these companies tonight. Kelly, I think a lot of this is because Google surprised positively, Facebook blew it out of the water, and these guys, unfortunately, were the ones that reported after those guys. So let's look at the numbers. The growth is still very substantial. There's a place for all 3 of these companies. It's just that the expectations got ahead of themselves, and yes, the valuation, I totally agree with everybody on the panel that the expectations and the value got ahead. So let's wait for these stocks to settle. Hey, look, by the way, if Google falls on this news, this is the one you want to pick up. It's trying to get 20 times earnings, not sales.
Josh?
Well, I think, when I look at, we have a different perspective because not only am I an investor in Twitter, but we have portfolio companies that work with Twitter. And I know over the last year, if you weren't offering a revenue feature that Twitter valued, then your partnership is likely going to be pushed kind of aside. And I think I'm seeing that change now. And I think you're going to see Twitter refocus on audience growth and not just revenue. I think that'll make a big difference in the company's future prospects.
Yeah, and just to keep everything in perspective, this is sort of a non-event. It's $56 a share, right? It went public in the 20s, and this is just a very modest correction. Let's see what happens on the call. The call is going to be very interesting. If they say anything on the call that hints at slowing growth, expectations not hitting where they wanted it to be, we're going to have a problem. If they talk about new initiatives, growth in new areas, commerce, things like that, we could see a little bit of a correction. So correction back up. So I think it's really not a big deal at 13% down.
All right, Josh and Brian, thanks very much for your thoughts at this hour as we keep an eye on that name again, down hard after hours. Coming